So I recorded a video a couple weeks ago with Peter Lynch showing a 2018 stock list, narrowing it down. It had like 9 stocks based on Peter Lynch's principles and gave you some ideas for future investment. So that one got a ton of likes. So I'm going to do another one this time for Joel Greenblatt. Going to talk a little bit about who he is, what his approach is, and why we should care. And then going to give you a list of stocks, just like the Peter Lynch one. Give you a list of 50 stocks we're going to run through, narrow them down, get ourselves a smaller list, and then use the Joel Greenblatt, what he calls the magic formula. Use that on a stock and show you how to make that kind of a calculation for yourself. So if Greenblatt's stuff really speaks to you, you can kind of pursue that further. And it's always great to get good investment ideas whenever you can. So if you don't know who Joel Greenblatt is, best-selling author. He wrote several books. Biggest one's a little book that beats the market, and You Can Be a Stock Market Genius. I believe those were both big bestsellers. Basically, crazy good fund manager. He, in a period of 10 years, averaged 50% annual return, and then basically quit after those 10 years. And now he's back with like index fund and a bunch of other funds. But that fund was called Gotham Capital. Basically. To understand the extent of like 50% annualized, if you were to put $1 in, and I think he started in 85 and then stopped in 95, something like that. You put $1 in, you get $52 out. So for each dollar, $52. That's insane. So he had a crazy track record. He timed it perfectly, got out, kind of retired at the top for that time period, for that track record, and now he's doing other things. So he's got what's called the magic formula. Gonna break that down in this video today. It's basically, so a couple things about it and something we need to keep in mind. This is going to be a big disclaimer about the magic formula. When he talks about it, and I believe he talked about it more in the little book that beats the market, this was all based on the idea of holding stocks for 1 year and then selling them after a year and then taking a new group and then doing it again. So it's not as applicable. There's a possibility that it could get you into some more risky stocks, ones that maybe you wouldn't necessarily want to have long term. So I'm going to talk about some things we can do to kind of mitigate that risk. If you look at some of his, so there's a little book that beats the market. You Can Be a Stock Market Genius, and The Big Secret. I have not read that one, but I don't know if that's a good book or not. I haven't really heard of it. But, you can see his performance, how insane it was. I believe this is hypothetically back-tested, so just talking about this magic formula stuff, right? So let's break that down. He does not include financial and utility companies, and I get that. Financial companies are a lot different. They have different leverage characteristics. I also tend to avoid them unless they're very, very conservatively leveraged, which is kind of few and far between. But I do currently have exposure to the finance industry. It's through a very conservative approach. So the second one is he talks about a market cap of 300 million or more. Basically, you want to make sure you have enough liquidity, right? That's the general idea. Have enough liquidity so you're not trading over the what's called over the counter and having issues with not being able to sell out of a position when you need to sell out. And it keeps you from a lot of like pump and dump type stuff too. So it's always good to have like a minimum market cap. And then he has return on capital. So this is basically what the two components of the magic formula are: return on capital and earnings yield. And so he has his own ways of calculating both of those. I'm going to show you exactly how. And basically the idea is he's not trying to get the stock with the best earnings yield or the stock with the best return on capital. He's trying to take a mix of both. So for example, if you had one that was like the worst return on capital stock and one that was the best earnings yield stock, that would rank somewhere in the middle because you're basically ranking these two together, right? And so, one might be excellent, but he really wants the two to be satisfactory, and basically he's going to rank those, combination of those ranks, and that's how he comes up with his list. I can't remember if it was like a 1 through 10 list or how many stocks he really tried to pick, but we're going to take the kind of generalized approach and assume we're just looking for a couple ideas, and so we're going to narrow down a list. Now, what's cool about Greenblatt is he made a resource that's available for anybody. All you got to do is sign up for a free account, and he basically runs these screens for us. So I'm going to show you just how easy he makes it based on his magic formula. So you just Google magic formula investing. You can go to magicformulainvesting.com, go to their stock screener, and kind of like we said, right, 300 million. Let's do 50 just because we're going to do some narrowing down later on, so you'll see why. So look, I mean, this is updated as of yesterday, and he has a list of 50 stocks that all score high on his magic formula rankings. So what I did, unfortunately, you can't like copy paste this. You can't export it. So me being the great guy I am, I manually inputted these into a spreadsheet. So we got the 50 companies here. And then we're going to take these 50 companies, input them into FinViz, and kind of narrow it down and get a better list that would be better, in my opinion, for more of the long-term type approach that I like to take. So let's do that. So we'll go to FinViz. I just basically copied this list, and then we're going to go to Screener. I'm just going to paste the tickers on here. So now we have that list. And I guess I lost one because I thought it was supposed to be a list of 50. Okay. Well, I lost one somewhere along the way, but it's not a big deal. If you want to be a stickler about it, you can go watch somebody else's video. I don't really care. So a couple things to narrow this list down. Now, there's possibilities that some of these companies have negative earnings. I have a strict policy against negative earnings. Like for when they have negative earnings, they won't show a PE. So like for this company, we can see negative income. And so this could be a possibility of, newest quarter data. You can see there is some lag there, which is just the way that quarterly data gets released in general. Sometimes the EBIT numbers are different from the negative earnings numbers, and I'll get into that a little bit too. But for the most part, I don't want negative earnings stocks. I don't believe you should want them too. So we're just going to put a simple filter and say under 35. Now, not only does that get rid of any of the high PEs, but also got rid of all of the PEs that are 0, all the ones that have negative earnings. Next one I'm going to do is debt to equity, and we just want to make sure that it's reasonable, right? I don't want to be, one of the things about this formula is he talks about earnings yield and return on capital. Both of those things have to do with earnings and profitability, but they're not really looking too much at the leverage. And so, he doesn't really care because he only has a holding period of a year. But in my case, right, if I want to hold this for 5 or 10 years, and if they're pumping out high returns on capital, but it's because they're highly leveraged, well, that's not a good situation that I want to be in as an investor. So we're going to go ahead and filter some of those out, get ourselves a debt to equity to at least under 1. So now we're at a list of about 28. And my last kind of stringent rule is I always like to buy stocks that are paying a dividend. That's up to you or not if you want to follow me on that. But that's just my MO. That's how I roll. So we got a list of like 12 now here. So from here, I believe this is a lot more manageable. It's a lot more reasonable. And I think it gives a better picture of some of the potential downfalls when we talked about Greenblatt and how he only wants to hold for a year. I think staying away from negative earnings and high debt to equities can really help mitigate those risks. So let's take a stock like Western Digital, WDC. So let's take this and let's calculate the earnings yield and the return on capital and Joel Greenblatt's formula just in general. And then I'll show you, this is how we're really going to get an understanding of it. And it's going to be pretty cool to see. They say the best way to learn is by doing. And so, what better way to learn what his formula is really telling us, right? Because once we dig into the financials, once we look at what the numbers are and we start to input them in a spreadsheet, then because we're forcing ourselves to look at those numbers and process them, then we can see, okay, this makes sense. Well, this is why he's looking for this, and this is why the company's strong in this point or in that point, right? And it can be very helpful. All right. So first thing we're going to want is an EBIT number. Believe that's also just like operating income. So let's take the latest one, 1954. And we want the market cap, which is here, 2688. So I put some of the calculations in here, right? So first thing we want is earnings yield, and the earnings yield is going to be the EBIT divided by the enterprise value. And I messed this up because this is actually supposed to be in millions and not billions, right? So what was it? 26.88 billion means 26,800 million. There you go. Yeah, that makes more sense. Okay, so earnings yield is going to be EBIT divided by enterprise value. Enterprise value is... Okay, we need to figure out enterprise value. So we need to put in basically market cap, and then we add the debt, and we subtract cash and cash equivalents. So let's go back to the financial statement. And let's look at our debt, which is going to be in the balance sheet. So you can see there's long-term debt there. Long-term, and then this would be like the short-term debt, I suppose. Yeah, because all of this stuff is current liabilities, but doesn't have to do with debt. So, but it's still talking about debt here inside those current liabilities. So that's like a more recent version of the long-term debt. So we want to include that. So let's call it 12,918 plus 233. So that's going to be our debt. And then cash and cash equivalents, that's pretty simple. Also up here in the balance sheet. And you can also find in the cash flow statement, cash at end of year is cash and cash equivalents, 6354. So let's think about that, right? Basically, the higher, so this can be a little bit counterintuitive, but the a PE ratio, you want a lower market cap. So enterprise value is trying to give us a better sense of market cap. And how it does that is it adds the debt and it subtracts the cash and cash equivalents. So, cash is good, debt's bad. So that's why, and remember, enterprise value is bad. So that's why we're adding debt, we're subtracting cash. And so the enterprise value, basically, based on the cash and the debt that's on the balance sheet, it's actually higher priced. So we get a yield of 5.8%. Now let's look at net fixed assets. Going to be total, if you look here, total assets minus total current assets minus total intangibles and goodwill. So this is basically just a metric of 29,860. It's more of like when you think of PPE, property, plant, and equipment. That's basically what we're trying to calculate here. 11,056 and intangibles and goodwill. Let's say 1014 plus 3823. So that's our net fixed assets, because now return on capital is going to be EBIT divided by net fixed assets plus working capital. And working capital is current assets minus current liabilities. Since we already calculated current assets here, now we only just need to add current liabilities there. And so that's going to be here, 4344. So we have our earnings yield and return on capital, 5.8% and 16.73%. let's do one more, and then we'll kind of compare and see if we have similarities there. So you think of the earnings yield real quick, by the way. You flip earnings yield and you get price to earnings ratio. So what I mean by that is 1 divided by 5.8. It's like a PE of 17. That's what it basically boils down to. So actually, their PE based on FinViz is a 7, but remember we're doing enterprise value instead of market cap. So it actually got worse, right? It went from like a 7 to a 17, but that's still pretty good, and it obviously ranked pretty high. I'm sure there's a lot of companies with higher enterprise values and lower earnings yields that are really, I believe this went from like, yeah, 17. So, sorry, this is kind of the way I like to learn as well. So you can see, like, if the earnings yield was like a 4, then that would correspond to a PE of like 25. So basically the moral of what I'm trying to say is take the inverse of the earnings yield and you'll get more of a sense of like basically what his PE is if he were to use enterprise value instead of market cap. So right out of 17 in this market is probably pretty good. And obviously it flagged up on his website. So that's something that makes it definitely a good one on this list and something to investigate further if you are so interested. IPG, let's look at that one as well. This should be pretty quick. Let's use SEC again. So really cool formula, right? Kind of going back to return on capital. The whole idea of that is like, okay, you're wondering why are they... when you think of formulas, it's like we want earnings yield and return on capital to be as high as possible. So when they put EBIT on the top, that means we want high EBIT, but then anything that's on the bottom, we want low of. So we actually don't want that much enterprise value, and we don't want net fixed assets, and we don't want working capital. Well, what's up with that, right? Net fixed assets, those are assets that's supposed to be a good thing. But what return on capital is basically telling you is the efficiency of a business. So a business that basically can make higher levels of earnings with lower amounts of, like it says, capital, or lower amounts of fixed assets. And then working capital is basically, it's almost cash, and then you're also adding like inventory and stuff and subtracting current liabilities. But that's what working capital is. So you're basically saying if they're able to make stuff happen, they're able to make lots of profits without too much property, plant, and equipment, and without too much inventory or cash, then it's going to be easier for these businesses to grow and really compound because they won't need as much cash or assets in the future. So that's kind of the whole thinking behind it. And it obviously makes a lot of sense, especially when you just kind of think it out and maybe run some numbers and do some analysis like we're doing here. So this one, let's look at their operating income. 973.6. And what I should do is let's grab all this. And get rid of that. So we'll still have our stuff being automatically calculated. And we can just enter it here. So this one. Market capitalization is right at $9 billion. So just like all the other spreadsheets that I tend to use on this channel, I will make this spreadsheet available for you. If you're a free email subscriber, I have a Google Drive folder with all of those spreadsheets. So you can start to do this. I mean, if you want to do the whole rest of the list and do it like I'm doing, as you can see, it doesn't take too much time at all. It's very helpful. You start to get familiar with the balance sheet and the cash flow statement, the income statement. You start to internalize what the numbers on the screen mean. So again, super simple here. Basically just the current portion of debt plus long-term debt. So really we're looking at 1287.6. Cash and cash equivalents, 790.9. Total assets, 12695.2. Current assets, 7464.1. And goodwill, I don't see intangibles in here, so we're just going to say goodwill by itself, 3820.4. And current liabilities, wrap it all up, 7678.2. That should fill everything in for us. Let's add a decimal place so we can see what's going on. Add one more. All right. Well, that's what we've got. So, huge return on capital. See, not so good of an earnings yield. So, if we were to use our calculator and figure out what kind of a PE that corresponds to. Well, actually, no, that's really good. Okay. Just kidding. Yeah, that's right. Higher earnings yield is better, and then that's right. We did like a 4% earnings yield to look, and the PE would be like 25. So this is really telling us like he sees it as like a 10 PE type stock. I mean a 9 basically, and then huge return on capital. So huge chances for improvement, pretty much. Huge chances of growth. Very efficient business. And so that was IPG. So that's going to kind of wrap it up for today's video. Hopefully it was helpful. Hopefully you got some great ideas now to move forward. You can use Joel Greenblatt's magic formula. You can use Peter Lynch's stock screener. I recently did a video with Warren Buffett's formula, right? With his owner's earnings. So all a bunch of different ways to try to evaluate stocks. Every single one has good aspects of it, stuff that makes sense. And so you just got to go out there and try to figure it out yourself. So I'm guessing it's this negative working capital that's really contributing to such a high return on capital value. Before I wrap up real quick, because it's kind of bugging me. So 74 and 76. So yeah, they actually do have negative working capital, which means either they're like selling out of their inventory super fast. Well, at least maybe it was just for this year, right? I don't know what the picture is like. Looks like last year was a similar case as well. Inventory could be selling really fast. Lots of other things could be happening, but we did check that the debt to equity was okay. So they do have enough liquidity as far as a long-term liquidity. So anyway, I'll stop now. But basically, hopefully that helps. Hopefully you got some ideas. And if you're interested and you like these calculations, you can definitely check out more of Joel Greenblatt and some of his books that he's done. So I'm going to say you got 3 options from here, as always. Number 1, subscribe to the channel. Click on the bell to get notifications for videos, great videos like this. Number 2, subscribe to the email list over at stockmarketpdf.com. You'll get access to this spreadsheet, the other spreadsheets I've used on the YouTube channel. You also get my free ebook, 7 Steps to Understanding the Stock Market, help you figure out what some of the stuff inside the 10K annual reports mean and some simple ratios to evaluate them. And you also get daily tips from me every single day. I really try to boil down the most important concepts in a short time period and package those in an email. In contrast to my very long videos, my emails are much shorter because I have stuff to do. Option number 3, and your final option if you don't like the first 2, check out the playlist I created on the channel called How to Analyze a Stock with Valuations. It's very helpful. It's more of like an in-depth kind of tutorial extension of the 7 steps to understanding the stock market. Stop working for money. Put money to work for you. Thanks. I'll talk to you next time.